If you're looking for a stable healthcare leader with consistent growth and dividends, my secret formula says Johnson & Johnson could be a good stock to buy today, and here's why. Johnson & Johnson is a global leader in healthcare innovation, but is the stock too boring for investors looking for big returns? J&J's whole business is worth about $360 billion, and the stock trades at around $144 per share, which will be important for later. Analysts expect J&J's revenue to grow at 3.1% per year over the next 3 years, with earnings expected to grow at 4.3% per year. Is this even good? For context, over the past 5 years, J&J's revenue grew at 1.6% per year, and earnings grew at 2.8% per year, which means the company is seeing a lower rate of growth going forward than it's seen in the past. In terms of the stock's valuation, J&J has averaged a 16 times forward PE multiple over the past 5 years, but today trades at just 14 times earnings. We'll use a 14 times multiple in our valuation. Make sure you pay attention to this next part. 3 years from now, analysts estimate that Johnson & Johnson will earn $11.31 in earnings per share. That means at a 14 times PE multiple, the stock could be worth $158 per share in 2 years. J&J is also expected to pay around $10 per share in dividends, which brings our total fair value to $168 per share. Is J&J undervalued? This implies that J&J could see a total return of about 17% or an 8% annual return over the next 2 years, including dividends. The market has averaged about 10% annual returns over the long run. It could still be a good stock to buy. Analysts think the stock is more undervalued because they have a price target of $172 per share, which means they see nearly 20% upside. This stock isn't going to soar 300% like Palantir, but